Hey, it's Lorne Andrews here from Dominion Lending Center's Expert Financial and optimalfinance.ca. So today, the age-old question, fixed versus variable. And the reason I'm coming out with this video right now is because I'm getting calls, and they're happening more often, saying, listen, I just saw the news, I saw this article, rates are going to be going up. Should I be locking in my rate? And so I figured, you know what? I really have to break down fixed versus variable and what it actually can do for you depending on what your rates are. There's two things. One is when you're in a fixed term, okay, and you're locked into that particular term, you have to understand that the biggest risk here is that the chances of you breaking that mortgage, I think statistically, are around 67% of mortgages get broken before 5 years. When you're in a fixed term, those penalties are extremely high, sometimes 4 or 5% of whatever your balance is. So you have to understand, when you actually see something on the news, the banks are saying, hey, be prepared, rates hikes increase, everything else. Their motivation is to get you into a fixed term. Banks profit from penalties. Okay, they profit from penalties. It's in their numbers, it's projected, everything else. They're anticipating a certain percentage of mortgages to be broken where penalties would be made, and obviously profits would increase. So you have to keep that into account. When you're in a variable mortgage, here's the thing: 3 months interest is your penalty. Okay, so 3 months interest, you get out of it. That is the way to protect yourself against penalties. Often people will come to me and say, you know what, Lauren, I'd like to know what my mortgage is for the next 5 years. Nothing's going to change. Okay, and listen, I love the idea that we don't expect anything to change over 5 years, but life is constantly variable. It's constantly changing. So our mortgage should have that same flexibility. I have somebody that may buy a condo and they think that they're going to be there for 5 years, and they end up meeting somebody and they start a relationship, they get married, they need to sell that condo and break the mortgage. That's what happens. Or something else, they want an investment property and they need to take equity out of that particular property. They need to break that mortgage so we can actually take equity out of that property so they can invest in something else. That happens all the time too. Want to do renos, other things. So having flexibility in your mortgage is key. So that said, let's look at a variable rate mortgage versus a 5-year fixed mortgage. Okay, so I just had a client come to me just recently, and I'm going to use their scenario as my example because I really wanted to drill down into it, because it's not just about penalties, but I need you to understand exactly how compounding interest works and how the interest rate will affect the proportion of principal and interest that's paid off that mortgage on a continual basis. So here's my example. This table that I'm going to show you right now, so this is a 5-year fixed mortgage. So if somebody wanted to go to a 5-year fixed mortgage today, the rate is, say, 2.89%, which is pretty average out there right now. Okay, so if we look at a 5-year fixed mortgage, and what I've done is I've broken down the table into 1 to 5 years. So when we look at it, the total interest that we're paying after the 5 years is $60,791. Okay, total principal that we're paying off during that time is $77,454. So this is assuming we're not making any extra payments. This is based on a 25-year amortization. This is what our payments are set. That's basically kind of the breakdown in terms of the proportion of what interest and principal is. So let's compare this to a variable rate mortgage. And I understand that a lot of times people say, oh, here's a variable rate, here's a fixed rate. They look at the table and it looks phenomenal, the difference. But there's going to be rate increases. We know there's going to be rate increases. So let's do this. Let's factor in rate increases over the next 5 years into a table to see exactly where we would end up after the 5 years. Okay, so we're going to look at the variable right now. So here's the variable table that we're going to look at. Now, the one question that would come up is, say for example, you're in a variable right now, and first if you want to go with a fixed. So let's say it's $461,000 is your balance. Your variable rate is at 1.85%. And the difference between the 2.89 versus 1.89 is about $200 per month in payments. So obviously the fixed would be a higher payment because the rate is higher. So what we're going to do is we're going to calculate, let's keep the 1.8, let's stay in the variable. We're going to take that $200 that we were going to be paying regardless, and we're going just to increase our payments by that $200. So the payments are going to be identical for either the fixed or the variable, okay? And what you're going to see is this is going to help create a little bit of a natural buffer in terms of how we're paying this mortgage down. And we're going to show you this in 2 seconds. So what we're going to do, we're going to increase the rates 1.5% over the next 5 years. Okay, so let's do this. So after year 1, here's a breakdown of what the loan amounts are and based on the 1.85%. But now let's say we apply a 0.5% increase. Now we're going to apply this on the front end. So if there's ever rate increases, it will be incremental throughout the period. They're never going to put a huge increase all up front. So you might see an increase of a 0.25% maybe in spring, and then maybe another one maybe in fall, let's say, for example. But for our purposes, we're going to load it up front, okay? So that way we do it. So now our new rate that we're actually going to be at is 2.35%. All right, so then we have the 2 years. Here's exactly what we're paying after the 2 years. Here's what our balance is. Okay, so now after 2 years, let's say another 0.25% increase in that particular year. So now our rate is increased to 2.6%. So now we go through after the 3 years. Here's our amounts that we're looking at. Let's apply another 0.25% increase. Our new rate is 2.85%. We go through that. Now we get to our 4-year total, okay? After the 4 years, between 4 and 5 years, let's throw in another 0.5% increase over that period of time. So we're throwing another 0.5% increase, and now our rate is 3.35% between 4 and 5 years. So now we look at the total interest compared to the 5 years. After the end of the 5 years for 2.89%, the 5-year fixed versus the variable, okay? And yes, I paid more interest in the variable with those price increases over the 5 years by almost, I'd say it's almost about $2,000, okay, $2,051 to be exact, okay? Albert Einstein, famous scientist, once said about compounding interest. He says, compounding interest is the 8th wonder of the world. He who understands it earns it, and he who doesn't pays it. And here is a great example of how this works. So we just saw how the interest, how you're affected with your interest between a variable and a fixed. And some people would say, oh my God, the bank just showed me the difference. Okay, I'm going to pay $2,000 more interest. If the rate goes up a 1.5%, I should lock in. Okay, this is critical. All right, so your principal that you're going to be paying off at the end of the 5th year, let's say you're in the 2.89% 5-year fixed mortgage. So here comes the magic, okay? After your 5 years, you're in a 5-year fixed. Your principal that you're paying off on that mortgage is $77,454, right? So $77,454. Now, let's go back to the variable. All right, we knew we paid $2,000 more in interest and variable. What about our principal? Our principal that we paid off on that mortgage is $97,961. That's a difference of $20,507 extra paid off your principal of your mortgage. Now tell me what makes more sense. At the end of the day, you have a lower mortgage balance. You're going to end up paying less interest in the total term of the mortgage. Your mortgage is going to be paid off sooner. You have to understand when payments are distributed with compounding interest, if we look at 2 payments, let's look at a mortgage payment. So a typical mortgage payment for $461,000. Let's say at 1.89%, they're saying, listen, your mortgage payment on 1.89% should be $1,929, okay? Of that, from the principal, $1,203 is applied towards the principal and $726 is towards the interest. Now let's look at the 5-year fixed, 2.89%. Those payments are about $2,159 a month, approximately $200 more than the variable payment, okay? So I'm actually paying more money. Am I paying more towards the principal? I don't think so. Principal payment for that $2,159 payment is $10,050, okay? And interest, I'm paying $1,110 towards interest. So my interest proportion is much greater Okay, it's about 10% difference in terms of it's a 10% increase towards the interest that I'm paying and a decrease towards my principal is 10%. The difference between going from that variable rate to the fixed rate. Okay, so like I totally understand the fear that comes behind with what if a mortgage payment increases, what if a rate increases, and again, to buffer this, it's about taking a payment. What would that fixed payment normally be? Find out what that payment is. Increase your payments to create that natural buffer within your variable rate mortgage. Okay. These are one of many reasons why you need to protect yourself and get the proper mortgage for you. Now, is the variable rate for everybody? That's not what I'm saying. What I am doing here is just kind of making you aware that what you're going to be hearing in the media about rates increasing, if you have the right mortgage with the right strategy, okay, you can be debt free and mortgage free much sooner. A mortgage is one of the biggest debts that you're going to get into your life, and I really feel that it's our responsibility to help you manage that debt. That's what we're doing here. I hope this was helpful. Any questions that you guys have, comments, anything, put it in the comments, suggestions, ideas, questions. We're here for you. We want to help you, and we're all about helping you leverage real estate to get to advance your position and to get you where you need to be in your life. Let's do this together.